Where do you start with investing? How do you grow your wealth without getting overwhelmed by complicated strategies? And is it really possible to make money without taking on massive risks? These are the questions everyone has when they first start. The good news, the answer is simpler than you think. In this video, I'll show you and John a step-by-step guide to dividend investing. I'll break down dividend investing into simple, actionable steps for beginners. From understanding the basics to building a portfolio that grows with purpose, I'll guide you every step of the way. And in the end, I'll show you and John how to create a portfolio that has the potential to turn $7 a day into a $900,000 portfolio that pays over $60,000 in annual dividends. All right, so let's start with the basics. What exactly are dividends? Well, when you buy a stock, you're essentially becoming a part owner of that company. Now, many companies, especially the successful ones, share a portion of their profits with their shareholders as a little thank you for investing. That's what we call a dividend. These payments can come in different forms, but cash dividends are the most common. They're typically distributed on a regular schedule, quarterly or semi-annually, for example. You don't just collect dividends, you can reinvest them to buy more shares, which earns you even more dividends, a process that's called compounding. Over time, this can grow your wealth exponentially. More on that later. To put it simply, dividends are a way for companies to reward their investors, and for you, it's a chance to earn passive income while building your financial future. And the longer you stay invested, the bigger those rewards can get. Why does this matter? Well, dividends can seriously boost your overall returns as an investor. Take the S&P 500, for example, a major market index. Over a decade, it's averaged about 10.92% annually from price growth alone. But if you reinvest those dividends, that return climbs to 12.99%. That's the power of dividends. They don't just add value, they multiply your wealth over time when you reinvest them. Now, some people argue that dividends aren't everything. There's even a theory called dividend irrelevance, claiming it doesn't matter if your returns come from dividends or stock price gains. But here's the thing. Dividends provide tangible, regular income, giving you something steady to rely on during market swings. They're like the anchor that keeps you steady when things get rough. Whether you prefer non-dividend payers like Amazon or reliable ones like Coca-Cola, dividends can be a game changer. But whatever your preference, I might change your mind. In the end, I will reveal a portfolio of stocks that can give you over $5,000 a month in dividends with only a $7 a day contribution. Now that you know what dividends are and why they matter, the next step is setting clear investment goals. Defined goals will guide your strategy and keep you focused, even during market turbulence. What's your purpose for investing? Are you aiming for steady income, long-term growth, or maybe both? Setting SMART goals, which is an acronym for specific, measurable, achievable, relevant, and time-bound, can help. For example, you could aim to generate $1,000 in annual dividends within 5 years, or grow your portfolio to $50,000 in a decade. With the right plan, this could evolve into a $1 million portfolio paying over $5,000 monthly in dividends. Your risk tolerance is just as important. Are you more conservative, preferring stable, low-risk stocks, or do you lean towards taking calculated risks for higher returns? Whatever your style, diversification is key. Spreading your investments across sectors like healthcare, consumer goods, and utilities can reduce risk and ensure steady returns even when one sector underperforms. Time horizon is another crucial factor. If you're investing for the long term, you can afford to take on more risk and benefit from the magic of compounding. For shorter-term goals, stability and capital preservation should take priority. For this video, we'll be investing $7 a day into a carefully curated portfolio. Developing a sound strategy is essential to make the most of dividend investing. Understanding key approaches, short-term and long-term, can help you build a portfolio that aligns with your financial goals and risk tolerance. Short-term dividend investing is all about generating immediate income, often by targeting high-yield stocks. For example, investing $10,000 in a stock with an 8% yield would earn you $800 annually, perfect for retirees or anyone needing extra cash flow. However, high yields can sometimes mean higher risks, as they may come from struggling companies. To stay safer, consider high-yield ETFs, which spread your investment across multiple companies and maintain steady income with less risk. Long-term dividend investing is all about patience and letting the power of compounding work its magic. The idea is to focus on high-quality companies that consistently grow their dividends year after year. For example, if you invest $10,000 in a stock with a 4% dividend yield and a 7% annual dividend growth rate, your income and portfolio value can grow significantly over time. Long-term dividend investing also benefits from the compounding effect. Let's break it down using the same example. In the first year, your investment generates $400 in dividends, 4% of $10,000. If you reinvest that $400 back into the stock, you're buying more shares. Let's say the stock price stays consistent. By year 2, you're earning dividends on the original $10,000 plus the $400 you reinvested. That means your dividends for the second year would be calculated at $10,400, resulting in about $416 in dividends. In year 3, your base grows again with reinvested dividends. This time, you're earning dividends on around $10,816, resulting in approximately $433 in dividends. Early on, these increases might seem modest, just a few extra dollars here and there, but after 10 years, your returns start to accelerate significantly. As more dividends are paid, they buy additional shares, which in turn generate even more dividends. This cycle continues and continues, creating exponential growth over time. For this video, we'll be using a balanced approach that blends the benefits of both strategies. Combining short-term and long-term strategies can help balance your need for immediate income and need for future growth. For example, pairing high-yield REITs, real estate investment trusts, with dividend growth companies in technology or healthcare can create a well-rounded portfolio. By diversifying across industries and yield types, you reduce risks while ensuring steady income and capital appreciation. Now that you understand the various strategies for dividend investing, it's time to show you my dividend stock selection criteria. This is how I select my stocks, and in the end, I'll show you a portfolio that can generate around $5,000 a month in dividends with only a $7 a day contribution. Building a strong dividend portfolio starts with selecting the right stocks. The first metric to consider is the dividend yield, which shows how much income you'll earn relative to the stock price. While high yields can be tempting, yields above 6 to 7% may signal financial strain or unsustainable payouts. Instead, focus on companies with balanced, consistent yields. Next is the dividend growth rate. A company with a history of steadily increasing its dividends is likely financially stable and committed to rewarding its shareholders. This growth not only boosts your income, but also helps offset inflation over time. The payout ratio is another critical metric. It tells you how much of the company's earnings are paid out as dividends. A payout ratio below 60% is ideal, as it indicates the company retains enough earnings to reinvest in growth and navigate economic challenges. Finally, evaluate the company's financial health, including debt levels and cash flow. Companies with low debt and strong, predictable cash flow are more likely to sustain and grow their dividends. So, based on these criteria, I've created a portfolio. It's a well-balanced mix of 5 diverse stocks, each offering unique opportunities for growth and income. At its core is Schwab U.S. Dividend Equity ETF with the ticker symbol SCHD, a reliable dividend-focused ETF with a dividend yield of 3.57% and a strong dividend growth rate of 11.04%. Its steady price appreciation of 7.69% makes it an excellent choice for those seeking consistent income and long-term growth. SCHD serves as a cornerstone for stability in this portfolio. Kroger Company, with the ticker symbol KR, a leading consumer staples retailer, complements this stability with a dividend yield of 2.18% and an impressive growth rate of 13.63%. While its price appreciation is moderate at 5.81%, its compounding potential through dividend reinvestment makes it a valuable addition, especially in the context of steady retail demand. Adding broader market exposure is Vanguard S&P 500 ETF with the ticker symbol VOO, which provides a lower dividend yield of 1.23% but compensates with consistent growth. With a dividend growth rate of 6.75% and strong capital appreciation of 9.8%, VOO is a key growth driver, offering diversification and a hedge against individual stock risk. This portfolio also includes Extra Space Storage with the ticker symbol EXR, a standout performer with a high dividend yield of 4.33% and exceptional growth of 13.6%. With share price appreciation averaging 8.4%, EXR leverages the resilience of the storage industry, delivering both substantial income and capital gains. Finally, there's AbbVie with the ticker symbol ABBV, a pharmaceutical giant, combining a solid dividend yield of 3.83% with remarkable growth of 13.65%. Its impressive price appreciation of 10.26% underscores its strength as a dual-purpose stock, providing reliable income and significant growth potential. Okay, let's stop here for a moment. If you're wondering where I get all this data from, let me tell you about our channel's official partner, Seeking Alpha. It has been my go-to tool for winning in investments. It's easy and simple, and I love how I can access under-the-radar investing ideas, earnings call transcripts, and breaking news. Plus, the exclusive database stock ratings have been a game changer. Stocks rated strong buy and their alpha picks have beaten the S&P 500 by over 80%. So definitely check them out in the description, as they promise to give a 20% discount on premium membership with a 7-day free trial and a 10% discount on Alpha Picks to anyone in our community who joins using the link from the video description. Okay, back to our topic. Each stock in this portfolio plays a critical role. SCHD provides stability with consistent income and growth. Kroger adds reliability through steady consumer demand. VOO ensures diversification and long-term market growth. Extra Space Storage offers higher yields, while AbbVie combines strong income with share price growth powered by pharmaceutical innovation. Together, these picks balance stability, income, and growth, creating a robust and diversified portfolio. This portfolio will have a dividend yield of 3.03%, a dividend growth rate of 11.73%, and an average share price appreciation of 8.39%. Now let's look at the future projection of this portfolio. If John contributes $7 a day, which amounts to $49 weekly or $213 monthly, here's how it breaks down. After the first year, John will have saved up $2,555. By the 10th year, the portfolio's value grows to $45,054 with an annual dividend income of $1,539. After 20 years, it'll be valued at $205,216, generating an annual dividend income of $10,052. Give it 10 more years, and by the 30th year, it'll grow impressively to $897,652, with an annual dividend income of $60,495 or $5,041 monthly. Over the period of 30 years, you would have invested $76,650, and the portfolio's total value added over 30 years will amount to $821,002, with $459,101 from capital appreciation and $361,902 from reinvested dividends. Want to know how to turn $10,000 into a $2 million portfolio using Fidelity Index funds? Click the video on the screen to find out.